Welcome to the deep dive. Today, we're digging into a pretty useful idea, actually.
Yeah.
It's about tackling market rallies.
Mm-hmm.
We found this trading tip 65 from someone named Mansi. And, well, it gets right down to it. How do you realistically make a profit from those big market upswings, without driving yourself crazy trying to nail the timing perfectly?
Right.
So our goal here is to unpack a sensible strategy for, well, riding those waves.
Exactly. And this tip, it addresses a really common challenge, doesn't it? Anyone watching the markets wants to jump in at the perfect time.
Oh, absolutely.
And it's frustrating when that just doesn't happen. So this offers a more grounded approach, a way to actually get involved in those rallies.
Okay, so the tip starts with a bit of a reality check. It says, you cannot catch each rally, which is almost, well, it's kind of a relief to hear, isn't it?
Yeah.
Like you don't have to beat yourself up every single time the market moves without you. The tip uses the simple scale, 1 to 10, to represent a rally's journey. What do you think about starting right there with that basic idea?
Well, what's really useful, I think, is that it sets expectations straight away.
Right.
So many people feel like they have to be in from the absolute beginning. And this tip is saying, look, it's okay. It's actually normal, probably likely. You'll miss that first little bit, that move from 1 to 2. It just takes the pressure off. You don't need to be psychic.
Takes the pressure off. Okay, so then comes the practical part. The tip suggests when the rally reaches 3, you realize that rally has started. So level 3 is our cue, our potential entry point. Why level 3, though? What might be happening there in our sort of hypothetical 1 to 10 market climb?
Well, if you think about the market dynamics, level 3 probably suggests that the first flush of excitement, it's been followed by some real buying.
Okay.
Maybe some confirmation that it's not just a tiny fleeting jump. You might see more volume perhaps, or the price stays above a recent high.
Right.
It kind of implies there's a bit more confidence building, that the move has legs beyond those very first really uncertain steps.
That helps. Waiting for a little more proof, essentially.
Yeah.
Okay, so let's say you're in around 3. Then if the rally does go all the way to 10, the tip suggests getting out around 7.
Yeah.
So that gives us that 3 to 7 window for profit.
Yeah.
But the big question is, why get out at 7? Why not hang on? Try for that peak at 10.
And that hits on something crucial in trading, right? Risk management and just how unpredictable market tops are.
Definitely.
The tip is really clear here. Top and bottom can't be predicted consistently. It's just, well, it's very difficult.
Yeah.
So exiting at 7, it's about locking in a good chunk of profit before the rally maybe starts to fade. It accepts that finding the absolute tippy top is incredibly hard. And often trying to do that just means you end up giving back your gains anyway.
It's that classic thing, isn't it? Aim for a solid win instead of getting greedy and maybe ending up with nothing.
Exactly. Don't let perfect be the enemy of good.
And the tip gives some context for those early stages, too. It mentions, only those who cause the rally to take shape enter at 1 and 2. Who are these people, these early birds, and why should the rest of us know about them?
Yeah, that's interesting. Those early folks, they're often the big players, institutions maybe,
Right.
people with a lot of capital, perhaps acting on early info, or maybe they're the ones whose big buy orders actually start pushing the price up.
Oh, okay.
For your average trader trying to mimic them, getting in that early, it's usually just not realistic, or maybe even possible. The point here is you don't need to be in that first wave to make money. You can actually profit from the momentum they create.
So it's not about being first in line. It's more about figuring out when the party's really started and then joining for a decent part of it.
Precisely. It shifts your whole mindset. You stop trying to predict the absolute future.
Yeah.
And instead you focus on observing what's actually happening, waiting for some confirmation, and then acting on it. Reacting, not predicting.
That feels much more manageable, less stressful maybe.
I think so. It's definitely more pragmatic, less driven by emotion like fear of missing out or greed. You're not trying to outsmart the entire market by catching the exact low point. You're identifying a trend that seems real, and then you participate in a sensible way.
And the main idea, which this tip really hammers home, is that it's okay. It's fine to miss the very start and the very end of a surge. The consistent profit, or at least the target, according to this tip, is found in grabbing that big middle piece.
That is the core insight, really. It's about accepting uncertainty. The market is uncertain.
Right.
And focusing on a goal that's actually achievable. Getting a good slice of the move. This could be really helpful for people who feel, overwhelmed or maybe discouraged because they feel like they always miss the best entry or the perfect exit.
Yeah, that feeling of always being late or leaving too early.
Exactly. This gives you a framework to avoid that feeling.
Okay, so just to quickly recap Mansi's trading tip 65.
hmm
We've got this hypothetical 1 to 10 rally. The practical strategy is look for an entry around level 3. That's when you have some decent evidence the move is real.
Some confirmation.
Right, confirmation. And then aim to get out around level 7. Secure your profits before things potentially turn,
Yeah.
because picking the absolute top and bottom, very, very difficult. A tough game, as the tip says.
Precisely summarized. It's just a reminder that, you don't need perfect timing at the absolute edges to participate successfully in these market moves. There's often a really substantial, profitable window right there in the middle.
It really makes you think, though, doesn't it? This whole idea, focusing on the main part of something, the meat of the opportunity, rather than the absolute extremes.
Yeah.
It feels like that could apply to so much more than just trading. Think about it. How might this principle, recognizing a confirmed trend and then aiming to capture the significant middle part, apply in other areas, other situations where, well, timing and opportunity are key? Definitely something to chew on.
It is a really good thought to end on.